Okay, so the world of finance, it's not just evolving, right? It feels like it's undergoing this seismic transformation, especially, at that intersection where traditional institutions meet the sometimes wild world of cryptocurrency. And today, we're going to do a deep dive into a whole stack of your sources. They paint a pretty fascinating picture of this evolution, everything from uh, groundbreaking presidential executive orders influencing retirement funds to major investment firms, carving out their crypto strategies, and even the nitty-gritty, the sort of human experiences of individual investors trying to navigate these crypto exchanges.
Yeah, our mission really is to pull out the most impactful insights, the key takeaways. We want to help you understand not just what is happening to these fast-moving currents, but why it profoundly matters for your own financial world, and how these shifting landscapes might shape your future decisions.
Right. We'll peel back the layers on the recent headlines, explore the underlying regulatory forces, and even delve into the psychology of different generations as they kind of brave this new financial frontier. So, yeah, let's jump in. Let's kick things off with, a monumental development. The Trump administration's recent executive order. It's rather boldly titled Democratizing Access to Alternative Assets for 401k Investors.
Right. This order, signed back in August 2025, it's a direct construction to the U.S. Labor Department and the SEC. It essentially aims to reevaluate the existing restrictions and, make it easier for Americans to include crypto and other alternative assets, things like private equity, real estate,
Yeah.
within their 401k retirement accounts and other defined contribution plans.
And when we talk about a major development, I mean, we're talking about a staggering amount of money here. As of Q1 2025, U.S. retirement assets totaled, what, $43.4 trillion, dollars,
Right.
with 401ks alone accounting for $8.7 trillion. Dollars. So when crypto potentially gets even a small slice of that pie, what's the actual magnitude we're looking at?
The potential impact is truly colossal. I mean, if even a conservative 1% of 401k funds were to flow into crypto, that's $90 billion in new institutional capital, just like that.
90 billion. Wow.
And some analysts are even anticipating maybe a 5% allocation, which would mean an incredible $450 billion. That's like 15 times Bitcoin's current market cap.
15 times.
The insight here, though, isn't just the huge sums. It's a profound signal, really. It shows crypto is rapidly transitioning from this, niche speculative thing to a legitimate, albeit still volatile, consideration within traditional long-term retirement planning. And this influx of what you might call patient capital could fundamentally alter market dynamics, maybe lead to different volatility profiles than we've seen before.
Yeah, industry leaders are certainly buzzing about this. Matt Hogan, over at Bitwise, their chief investment officer, he sees this as potentially transforming crypto markets. He talks about introducing a slow, steady, consistent bid from retirement contributions, which he thinks could lead to higher returns and lower volatility. He clearly believes crypto belongs in 401k, at least for some investors. He called it the best performing asset class in the world over the past decade. Strong words.
Mm-hmm. And Ji-Hun Kim, CEO of the Crypto Council for Innovation, echoes that sentiment, adding that this decision really affirms digital assets' fundamental place in the U.S. financial system, emphasizing that, quote, Americans should have the opportunity and freedom to include these investments within their retirement plans.
But, it's rarely all smooth sailing in the crypto world, is it? Critics and experts are definitely raising some important questions about the specifics. Michael Heinrich, co-founder and CEO of Zero G Labs, called it a watershed moment, but cautiously added it could go both ways.
Right. He stressed that the devil will be in the details. Things like, which specific tokens qualify, how are they custodied, like held securely, what guardrails are put in place.
Crucial details.
Yeah. He even warned of potential political and financial backlash if it's done poorly.
And Arthur Brightman, co-founder of Tezos.
He supports more investment choices, generally, but warned that many investors could just make poor allocation decisions. He specifically cited things like high fees, hard-to-determine pricing, and manager manipulation to mask volatility as, common problems with private assets. These are often the very concerns supervisors have when assessing new types of investments for retirement funds anyway.
Right. And then there's Peter Schiff, the well-known gold advocate and, let's say, crypto skeptic. He weighed in with a pretty stark warning, said this could actually worsen the U.S. retirement savings gap. His quote was, by allowing Americans to gamble what little retirement savings they have in their 401ks on Bitcoin and other cryptos, Trump just made this problem much worse.
Which brings up a natural follow-up question, right? How do pension funds typically approach these alternative investments, historically? Well, even going back to 2011, Organizations like the OECD IOPS, that's the Network for Pension Supervisors, they've recognized that alternative investments, including structured products, can offer diversification, potentially improve risk-adjusted returns, but, and it's a big but, they come with significant risks.
Like what kind of risks?
Think illiquidity, meaning you can't easily sell them for cash. Integrity risk, where the underlying assets might be questionable. Or operational risk, just the dangers in managing these complex holdings. They're often more complex, more expensive to manage, typically designed for high net worth individuals. And this is precisely why supervisors collect data and provide guidance, emphasizing robust, risk-based oversight.
It sounds like a very delicate balancing act then. Russell Investments, for instance, highlights how funded status volatility, basically how much a plan's assets jump around compared to its future debts, how that creates problems for pension plans, leading to unexpected contribution requirements.
Exactly.
But their three-legged stool approach, focusing on diversification, managing liability sensitivities, and how they interact, apparently led to a 40% reduction in that volatility for their clients between 2015 and 2020.
Yeah, which suggests that with the right risk management strategies, a smoother ride is possible, even when markets are choppy. It's all about careful navigation.
Yeah. Okay, speaking of careful navigation and those safeguards, how are the biggest players in traditional finance, the ones managing all this capital, actually approaching crypto? Our attention naturally turns to firms like BlackRock, right? There's been a lot of buzz about whether they launch spot ETFs, that's the exchange-traded fund holding the actual asset, for things like XRP or Solana, especially after that Ripple SEC legal battle sort of settled down in August 2025, clearing up some uncertainty around XRP.
Right, but BlackRock moved swiftly to clarify. They said they have no current plans for XRP or Solana spot ETFs at this time. This statement was made August 9th, 2025 on the Crypto Prime podcast. What's compelling here is that BlackRock already offers spot Bitcoin and Ethereum ETFs. They're not new to this game.
Exactly.
Speculation really ramped up after Ripple and the SEC agreed to end their appeals in that long-running case.
So if they're not diving in right now, what does that signal for XRP and Solana? Are they just like staying on the sidelines, or is there a bigger strategy?
Well, while some market watchers thought the legal uncertainty was the main thing holding them back, James Seifert, a senior ETF analyst at Bloomberg Intelligence, disagreed. He pointed out BlackRock had plenty of time to file earlier if they'd wanted to.
Interesting point.
Alexander Bloom, CEO of Two Prime Digital Assets, noted XRP's market value is, well, less than half of Ethereum's, suggesting BlackRock might simply be focused on growing its existing Bitcoin and Ether funds for now. Which leads to an intriguing question, doesn't it? Could BlackRock's strategy be to kind of watch the market, let competitors launch first, then respond based on actual investor demand? Nate Gerasi suggested this, and it's a classic move in mature markets, right?
Okay.
Observe, then act.
Yeah, that makes sense. And it definitely seems like other firms are leaning into that approach because they're pushing ahead. Franklin Templeton, ProShares, 21 Shares, Canary Capital, Bitwise, they've all already filed for XRP ETFs.
They're not waiting.
No. And Bloomberg analysts even raised the year-end approval odds for spot ETFs linked to XRP, Dogecoin, and Cardano to 90% back in June. So the momentum is there elsewhere.
And Vivian Fang, a finance professor at Indiana University, actually believed it was more likely we'd see ETFs for altcoins like Solana before one for XRP. It just highlights the truly diverse, sometimes conflicting approaches firms are taking, all happening in a market that saw its global crypto cap blow past $4 trillion for the first time as of mid-July 2025. It's a landscape of, cautious pioneers and bold challengers.
Okay, we've talked about the titans, the big firms, their strategies. But what about the millions of individual investors actually navigating this landscape day to day? Let's shrink our focus a bit and peek into the everyday realities of interacting with crypto, starting with the human element, the investor psychology.
Yeah, what really stands out to me here is how profoundly different life experiences shape how people approach investing in this space. Take millennials, born roughly early 80s to late 90s. They're often seen as like the pioneers of the digital revolution.
Right. Grew up with it.
Exactly. They're incredibly open to tech innovations, often view crypto as a tool for portfolio diversification. And sometimes, it's even a way to express a philosophical disagreement with traditional financial institutions.
So it sounds like they're generally more willing to take, let's say, calculated risks then.
Yeah, it's a strong characteristic, yeah. Millennials are often defined by a higher risk tolerance, willing to invest a significant chunk of their savings in crypto, often inspired by those stories of spectacular gains, right?
Yeah, the moonshots.
They really do drive demand for new, innovative cryptocurrencies.
Okay, and then we have Generation X, born between the mid-60s and early 80s. What's their take? Are they less adventurous, maybe?
Well, Generation X, there's this crucial bridge,
Yeah.
between the analog and digital eras. They typically approach crypto with more caution. They prefer a balanced portfolio, a mix of modern assets like crypto alongside traditional
Makes
investments.
sense.
Their primary focus is often financial stability, long-term prospects like securing retirement funds. They tend to provide a layer of market stability, kind of balancing some of the excitement we see from millennials.
Okay, this leads us neatly into the practical side of crypto investing, actually using the exchanges. We saw this Reddit thread that really highlights the challenges some users face. It was pretty striking. One user, Ben Bet, reported their Coinbase account got locked after receiving just $400 in Solana, SOL, and Coinbase suddenly claimed this unrelated, like $1,500 debt from 5 years ago from an account Ben Bet insisted they never even used. It sounds like something out of a Kafka novel, right? Locked out of your own funds over some phantom debt.
Yeah, that story really underscores a critical issue. The Reddit thread included all this speculation about potentially tainted funds money that might have passed through illicit channels, but also just an outpouring of complaints about incredibly poor customer support from Coinbase.
Yeah, that came up a lot.
Users described spending hours on the phone with zero resolution, accounts getting locked or closed without clear reasons. Several users said they were planning to move to cold storage those offline wallets for max security, or just different exchanges like Kraken or Strike.
Although some did admit Coinbase's fees were lower, which keeps people there.
Right, the trade-off.
And this frustrating experience, it ties directly into a broader critique we found from John Reed Stark. He's a former SEC Enforcement Division chief, and he stated quite bluntly that crypto trading platforms are, quote, high risk, perilous, and inherently unsafe. Pretty strong language.
It is. And if we connect this to the bigger picture, Stark argues that a key reason for this peril is the glaring lack of U.S. SEC registration for most crypto platforms. This means there's this significant chasm in customer protections compared to traditional SEC-registered firms.
What kind of protections are missing?
Well, they typically lack mandates for properly handling investor funds, ensuring transparency on risks and pricing, adequate disclosures, comprehensive SEC oversight for, detecting fraud or enforcing violations. Crucially, there are often no mandated cybersecurity requirements, no formal complaint resolution structures, and no minimum financial standards for them to even operate.
That's a stark contrast to traditional finance, isn't it? But for an industry that often prides itself on decentralization and, less oversight, is there an argument for why that chasm exists, or is it just purely a flaw?
It's a complex tension, absolutely. The industry often champions minimal oversight as a path to innovation and, financial freedom. However, this regulatory vacuum demonstrably contributes to persistent security gaps. I mean, the numbers are pretty stark. In 2024 alone, over $10 billion in crypto was lost to theft globally.
$10 billion?
Yeah. And this includes illicit activities like wash trading, where deceptive volumes fool investors into thinking there's more demand than there really is. Or even state-sponsored cybercrime. North Korea-linked thefts amounted to $1.34 billion in 2024 alone. These figures really highlight the scale of the problem when robust consumer protections just aren't consistently in place.
Yeah, no wonder public confidence in crypto safety isn't exactly soaring.
Precisely. Among all informed adults, only 7% say they're very confident in crypto safety, while a significant 26% are very unconfident.
It's a big chunk.
And among people who've never owned crypto, that very unconfident figure jumps to 41%. Now, current crypto owners are more positive, 13% very confident, 47% somewhat confident. But even then, a notable portion still has reservations. It truly underscores the need for clear, consistent regulation.
Right. And despite